So like the S&P continues to close at weekly higher highs for a second week in a row, continuing the bullishness. We got CPI on a deck this week, along with Jerome Powell. So there's only one certainty for Wednesday, and that is that it's going to be volatile like no tomorrow. Good morning or evening, ladies and gentlemen. Hope you're having a wonderful Sunday, or if you're watching in the future, hope you're having a wonderful day as well. Today, we're going to be talking about the jobs report, CPI expectations, PPI expectations, Powell. We're going to be talking about NVIDIA a little bit as well, the key levels for the market, biggest winners and losers, and so much more. We also got some news from Moody's that we're going to be sharing with you in the discussion part of the video. So if you wanted to jump to that, it'll be all time-stamped down below. And as always, thank you all so much for tuning in. So first of all, S&P closed at a higher weekly high. We went over this in the last weekend deep dive that we wanted to see 533 be broken. I also said that if we start rotating above that 9-day moving average and really 530.27, that we would get that catalyzed to the upside. We got that on Wednesday, where we basically got the ECB, Bank of Canada cutting rates decision, and we just went higher, right? We went higher, and higher, breaking into new territories. However, on Friday, we did get a sell-off, right? So if we go into the 5-minute chart here, we can clearly see what happened on Friday, right? So we get the jobs numbers reaction, which was bearish initially. However, it did reverse subsequently afterwards, and then just kind of chopped around into that 1-2 o'clock hour where we just lost a lot of momentum, closing still above that key level, but not by much, right? So it puts into contention, do we get that continuation as we're going into these catalyzed events? And we got to keep an eye on that. So first of all, let's clean up the chart, and so you guys can have the weekly levels that we have to pay attention to for us. And here we are. As you can see, the S&P has a pretty big wide range for this week. And the reason I'm saying 530.27 is going to be a really key pivot point for us is because it's where we rotated previously, broke the resistance. We should find support on it. On top of, we actually can snap another line to these higher candles right here, where we basically rotated off of, which is our previous all-time high, 531.52. Again, I'm giving you guys the cash market numbers just because it makes more sense for you guys versus a lot of you don't trade futures. So I'm trying to give you the numbers for the SPY versus like the ES, SPX, right? So just making sure that's clear. So really, we have a lot of key areas around 531, 530, and we really do not want to consolidate in that area. We want to avoid coming back down to it. We want to be heading strong into CPI. That'll mean the bulls are in charge. And again, if we look at fear and greed index before that, we can clearly see the bulls are lacking some momentum, some breadth in the market. And that means we could basically get some retracement during the week. Now, the S&P also traditionally likes to retrace 50% of any move. So if we say a 50% retracement, that's coming down to 527.63, not around any key levels. It is the area where we had a previous gap fill, right? We gapped down here and then pushed up higher. So again, I'm not necessarily looking for that retracement level. I'm more looking towards that upside potential, especially because we started that broader rotation. The one thing that I would say is concerning is the selling wicks on the daily candle. That if we jump back to here, as you can see here, there's a pretty big selling wick on the S&P. Okay, so if we start rotating up, then okay, we can continue that momentum into CPI and thus continuing that bullish run. If we start breaking down below 530, then I'm going to be starting to look at downside potential. Do we thread in 543 previously that we talked about here, which is the previous all-time high break that we pivoted off of before, and it's still in place. So again, the levels that we really need to pay attention to is going to be that 530 region, specifically 530.27, warning sign at 531.52 that, hey, 530 is now in jeopardy, and then 536.89 as the new all-time high breakout for not on a closing basis, obviously, and then 524.38 as the danger zone. Our theory is wrong, and we really need to be looking at downside potential at that point because 522.60 is now in play. So again, for you guys out there, pretty massive range on the S&P. Now let's jump over to the NASDAQ and see if it has anything different to tell us. So we can clearly see the NASDAQ has a little bit of a different story. We don't have as much support as we had on the S&P, and our 459.74 level is the pivot for it. So again, we got some downside momentum. This could be interpreted as a bullish flag right here. And we could be setting up to break to new all-time highs. Breaking above 465.74 would be considered that new all-time high and trajectory to that 500 magical number. Again, that's a psychological number for the Nasdaq, so it's going to be a point of resistance once we get up there, but we do have a lot of work before we get there. So is this going to continue? Well, we need to see if we break above 465 first of all, and then are we going to start threatening 460, right around that region? Once we're below 460, we have to be looking at retracement potential all the way down to the 450 area, and mainly paying attention to 449.34, which was a rotationary pivot, along with 447.90. Once that level is taken out, then we're looking at that 50-day moving average sitting at 441, which would be from the point we are here all the way there, a 4% decrease. So not impossible going into a CPI Powell event. So I just want to keep that in the back of your mind that we are heading into two major catalyst events that we're going to be talking more about in the discussion part of the video, what we're expecting and kind of the game playing the scenarios out there. However, for me, I'm going to be taking as little risk as possible going into that week, because significant risk going into these catalyst events has burned me in the past, and therefore I'm not really looking to put a large position size on it. I don't think you should as well, just because all these levels, you may be thinking it's going bullish, you may be thinking it's going bearish, and it completely reverses on you either way which side you're on. If the news event goes against you, right? Yeah, it could go for you, but it could also go against you in a heartbeat, and it's pretty much better to play the reaction once it's confirmed versus waiting for all the speculation, right? Yes, you can speculate and make more money. However, you're going to lose money over the course of a longer period of time because you're going to be wrong on that speculation versus the reaction. And then having that full reaction reversal is a little bit unlikely, right? If I have to play the odds. Now, the one thing I am concerned about is the Russell. The Russell is in an area that I'm like, okay, this is a classical bearish pattern, right? We have lower highs and lower lows as well. And that signifies we're below the 50. Okay, so now I'm looking at potential targets below 200 weekly moving average and 200 daily moving average. That's bad, right? So small caps are basically just in a lot of pain, right? If we look at the daily, and I want to bring something to your attention, we are not at all-time highs. We have not even gone back above the previous volume area that we had previously around that 210, 212 area, which was the 2021 to 2022 stagnation of small caps. And that's significant. There's a lot of selling pressure right here that people are just wanting to get out of this small cap market, and we really haven't bid it up. So it's very peculiar seeing how the S&P since the start of the year has been running massively while the IWM only has appreciated from the start of the year roughly. We're looking only 4% versus S&P that's returning 12 to 14%. Again, due to those magnificent 6 or 5 companies, which is not a broader bullish market, and why I still cling to my bearish theories about the yield curve. And also after this, we're going to be talking about Bitcoin and how it's not doing too hot. It broke below a level that I said it should not break down below. And now we have to look at downside potential on Bitcoin. So again, we're going into CPI and Fed as well. And we're not certain that we're going to get this bullish reaction that we're looking at. Now, if the Russell by the time of CPI is above 202.55, then I'd be looking, okay, maybe I was wrong. But looking at this, I'm just saying, okay, we have gap fill potential on the Russell right here, and we don't have a lot of price structural supports going all the way down to the 200-day moving average, weekly moving average. That is not good, right? Russell selling off 4% is not going to be good for the S&P or Nasdaq. You can't have as much rotation into these mega cap stocks before it's all just selling. And some of these mega cap stocks aren't doing so well. If we just pull up Microsoft, right? Yes, having a push up, but not really that strong. We consolidated around that 50-day moving average for way too long, in my opinion, and it's looking like it's hitting some resistance up here. Apple looking stronger, but Apple's been on a pretty much big downtrend as the broader market was buying up. Now, trying to have that golden cross in Apple. So, okay, we're getting a mixed bag signal here. Again, CPI is subject to all this changing. If we look at Google, right, Google was pretty strong, and Google stays strong for quite some time. We got NVIDIA actually having its stock split at the time of recording this video. So therefore, this is going to be $120 on Monday's open. So make sure you guys denote that price action there. However, price action as a whole is still going to stay the same. And if we look at companies like Netflix and Amazon, they're doing okay, but they're similar to Microsoft, where they were not really showing that broader strength. RSP also not above the previous all-time high, which I've denoted as 164.90. That goes back to our 2022 all-time high. We really have been chopping around this area where we're forming essentially a symmetrical wedge right here that we're looking like we want to break. And therefore, we have a lot of potential to break to the downside. On top of, if we look at the riskier assets like Bitcoin, then, well, looking at this, we look like we have a failed breakout, right? Broke the inverse wedge outward and now are failing to hold it. So that means we have a lot of price action that could pull us down all the way to sub 50,000 on Bitcoin. First level that has to give is the 50-day moving average that's sitting at 66,000. If that level gives, and we could get it based on what Jerome Powell has to say, then we're threatening all the way down to 50K, and that's going to be a pretty bad sell-off for Bitcoin, and means that risk is going to be taken out of the market. It's just going to be broader selling. We're not the magnificent 5 or 6 is not going to be able to keep us up. And we also jump to larger markets like China, right? Not doing so hot around here. Nikkei just been sideways as the S&P has been pushing higher. And last but not least, we can take a look at VIX. VIX has basically been consolidating around this region and hasn't really given up the gains. Still holding at that $12 level. So just preparing, people are still buying insurance. They're not completely selling off of it. But it's setting up where there's a lot of complacency in the market. And all it takes is a CPI print or Powell to come out and give you guys some bad news. But first, before we dive into all the CPI and everything, we're going to talk about the biggest winners and losers, and Fatal is going to give you that. And then we'll be back to have a discussion piece about CPI, jobs, and all that fun stuff. So thank you all so much for watching thus far, and Fatal will take it away.
So after the ECB cut rates in Europe, we saw that there really wasn't much movement when it came to US markets. As you guys can see over here, the S&P 500 really just didn't go anywhere, at least on Friday. Now, on the 5-day, this thing did go up at around 1%, 0.97%. However, we are still at 52-week highs when it comes to the S&P 500. And the main thing that we have to take from this is the fact that, well, CPI as well as the FOMC meeting is on Wednesday. So that's going to be a major catalyst when it comes to overall volatility this week. Looking at the next upcoming earnings for June 10th, we can see that on Monday, guys, we really don't have anything. Tuesday, Oracle, honestly, that really is it. Wednesday, we have here Broadcom, Vera Bradley, and Oxford Torrid. Honestly, aside from Broadcom, the main thing that we're going to take from Wednesday, it is none other than the fact that, yeah, CPI is coming out for the month of May, as well as the FOMCs on the exact same day. Very interesting. Again, massive volatility is going to be on this day. And on Thursday, we mainly just have Adobe and I guess maybe RH. I guess, not really, but just it's mainly going to be Adobe and nothing on Friday. Looking into now the heat map, we can see that this is straight up split, almost like on a diagonal. The bottom half of this, it is mainly in the red. The top half of this, it is mainly in the green. Starting with the technology sector, the worst performer here, it is the company Microchip Technology, losing 4.5%. And the best performer, it is the company Hewlett-Packard Enterprises, gaining 13.48%. Also got to give it, guys, Nvidia also did 10.27%, guys, $1,208.88. I believe that their stock split is happening this upcoming week, so this thing will fall to around $200 or so. Looking further now into the communications sector, okay, we can see here that the worst performer, it is none other than Charter Communications, losing 3.58%, and the best performer overall, it is, well, Meta, gaining 5.6%. Looking into now the consumer defensives, the worst performer here, it is in the same location as I believe we had the best performer. Yeah, that's actually kind of funny. We can see here that the worst performer overall, it is none other than Dollar General, losing 7.5%. Target lost also 6.5%, and Dollar Tree lost 5.65%. The best performer, the exact same sector, it is, or in the exact same industry, it is the company Costco gaining 4.41%. Look at that graph. That graph is absolutely insane. After a certain point, it just went hyperbolic. The healthcare sector, it is actually decently in the green. Worst performer here, it is none other than the company. It seems to be the company, guys, West Pharmaceuticals. You guys can't see that, and I'm so sorry. I can't. Actually, there it is. It is the company West Pharmaceutical Services, Inc., losing 5.5%. And the best performer in the whole entire sector, if hopefully I could get it, it is the company Illumina, gaining 9.03%. And guys, UNH is still under $500 at $490. So may still have a chance to get this thing sub 500 for the time being, but who knows when this turn will occur. Looking now into the financials, specifically the banks, honestly, this is massively in the red, guys, pretty much all across the board. I believe that there are a few banks that have been, I guess, in fear of being bankrupt. We'll probably cover that towards either the debate or sometime this upcoming week. Nonetheless, though, we can see here that the worst performer, it is the company CMA Commercia, I think that's how you say it, losing 6.23%. And the best performer, it is PayPal, gaining 6.84%. The consumer cyclicals, okay, we can see a lot of 50-50 going on over here. Worst performer, it is none other, yeah, I think it's that one. Yeah, it is 100% that one. It is the company Bath and Body Works, losing almost 11.75%. And the best performer, guys, by the looks of it, seems to be the company CCL, Carnival Corporation, gaining 10.75%. The industrials right now are in absolute chaos, all for except just a few companies. Honestly, you got some of these like ETN losing 5.5%, guys. Maybe a time to buy some of these companies, honestly. We can see here that the worst performer, it is none other than the company, yeah, it seems to be the company Builders First Source, losing 9.02%. And the best performer, ironically enough, Boeing, gaining 7.11%. Real estate's just kind of not doing anything. The worst performer here seems to be the company Alexandria Real Estate, losing 3.79%, and the best performer, it is the company Iron Mountain, gaining almost 6%, 5.92% to be exact. The utility sector crashed pretty decently this week. You guys can see over here, all of these are in the red. So we're not going to have a best performer, just the one that lost the least. Overall, though, the worst performer, wow, it is none other than the company Vistra, losing, well, you guys can see it right there, 14.14%, guys. And I guess the least worst performer, the one that lost the least, would be the company Duke Energy, only losing 0.92%. And similar to that of the utilities, the energy sector was also hit hard. Wow. Again, almost all of these lost. Only one of them slightly gained. Worst performer here, it is none other than the company, seems to be the company Halliburton, honestly, losing 7.14%. And the best performer, I guess the only green performer here, would be the company Kinder Morgan, gaining 0.67%. And lastly, the basic materials, most of these are reeling. You guys can see that, man, most of these are deeply in the red. Only a few of them were decently in the green. And we can see here that the worst performer, it is none other than Mosaic Company, losing 8.57%. And the best performer, it is APD, Air Products Chemicals, gaining 4.81%. You guys can see that graph right there. That's a massive jump from APD just from a few months ago, if I'm not mistaken. So all in all, this is going to be one of the biggest volatile weeks that we've had to date. I mean, the fact that CPI is lining up with the FOMC on the exact same day, it is absolutely insane. So that'll be fun. And we will be live streaming, guys, on Tuesday and Wednesday. But specifically for me, I'm actually going to go on another creator, only on Rumble though, another Rumble creators live stream also on Tuesday after the normal stream that we're going to have. So it'll be very, very interesting. It'll be talking about gaming, nothing really dealing with investments, though I will sprinkle that in just a little bit if they ask me questions regarding that. Nonetheless though, this is the S&P for this past week. With that said, take it away, Mike.
So we're going to start off today doing a little something different. We're going to do the Fear and Greed Index first, and then we're going to talk about a bunch of other articles first. So, sir, what do you think the Fear and Greed Index is at?
I believe, I don't remember if I saw it this week or last week, but Last time I believe it was like at around neutral. So seeing the fact that the market did go up by around 1% this past week, I'm gonna say greed.
Okay, so you would actually be wrong. It's smack dab touching fear, which is very peculiar, right? So we're going to be talking about a lot of peculiar things today because this doesn't necessarily inspire confidence that everything is okay, right? And the next couple articles will show that as well. But I was actually expecting it to be above 50, right? I still thought we would be in neutral, but I didn't expect us to be like hugging fear, right? Going into CPI.
That's a little bit That's a little bit not concerning, but weird because again, the market did go up 1% this past week.
Yep, and I would say it's concerning because really the bulls have been capitalizing on it. Why is this indicator showing other things, right? We're not seeing that true breadth in the market because of small caps. Also, like I covered when I went over the Russell, is that small caps are not doing well, right? They got bid up on rate expectations and then got sold off immediately. Only the Magnificent Five are doing wonderful. And also we had the ECB this week, say inflation's over, right? They cut rates. They said we're done raising rates, we're cutting rates, right? So that to you signifies, and correct me if I'm wrong, hey, we're done fighting inflation. That makes sense, right?
Well, not only, yeah, but it's funny because we did cover this on the live stream, and I showed the fact that even though they did cut rates by 25 basis points, inflation was still going up for them.
Yeah, and then they come out a day later and say this. ECB President Lagarde, we've made major progress. Yeah, right. But the inflation fight is not over. Like, don't you love that quandary in the same sentence?
It's the inflation's transitory negative again. That's all that is.
It has to be at this point, because I can't chalk it up to anything else, right? We're confident inflation's going down, but we won't, like the Fed. We're confident inflation's going down, but we won't cut rates. Yeah, we need more confidence.
Right. But then why would you cut rates if you were confident that inflation is coming down, but at the same time inflation fight is not over? So then why cut rates? I don't now. It doesn't make sense.
Now, not to go off on a tangent, Ray Dalio's book, he talks about how policymakers have to create like a beautiful deleveraging, as they call it, where they're pulling different levers at different times. When you have deflation, for example, during traditional crashes, and note why I say that. During traditional crashes where the market's falling off, you have deflation, and they have to create it by turning into a beautiful deleveraging by creating inflation that subsequently net zeros the total inflation deflation, right? Whereas here, you have inflation, and then you're doing things like you were acting if you had deflation. I'm like, you guys need to go read Ray Dalio's book because all of you are doing everything wrong. This is going to turn into what he calls a bloody deleveraging in his book.
Well, I'm going to have to go even a step further. The idea of a central bank to begin with, that idea is wrong, right? So, it's like you're trying to solve a problem using the wrong process, but the thing that's trying to fix the problem is also the one that created it to begin with. Yeah. Right, the one that created it to begin with. So it's the blind leading the blind. That's why, at least here on the channel, we're so against the Fed. Like, we're really against the Fed.
He takes a different stance about like central policy and central like banks, right? He differs in our opinion than that, but it's still, he gives criticism to a lot of these institutions that are like, you don't know what you're doing. You basically are essentially creating inflation while there's inflation, thinking you need to do it because there's deflation. But he's just like, reading his book, it's like you're looking at this and like, okay, so this is every wrong deleveraging gone wrong wrapped up into a basket together. So it's going to be fantastic. I highly recommend anyone read his book, Principles of Debt Crises, especially the 2008 section. He talks about how he literally saw 2008 coming, the hallmarks and everything, and it's really a good read. But before I digress on a tangent where he talks about bubbles, right? There is one bubble that blew my damn mind, and you probably can figure out which stock it is.
The bubbles of all bubbles.
Yeah. That statement you just made, I want you to read this next thing.
Okay.
I'm going to highlight it for you.
Nvidia has gained $2.68 trillion in market cap value in a little over 17 months. Yeah. It's literally, they are almost they're almost past Apple. And how long did it take Apple to get to that point?
Years upon years, decades.
Decades.
That's the
And
thing.
these
You've
guys
literally
did it in a
gained
year.
a year and a half. You've gained 80% of your market value.
Yeah.
If
Tell me
that's
that-
not a bubble, I
get
can't
that-
describe it.
I get that people say, yeah, but it's AI. It's AI. I'm just like, and I would argue the internet, the creation of the internet is bigger than AI, right? Because the internet is the foundation. Without the internet, you do not have AI, and we all know what happened with that.
Yeah, and I think the thing that people construe about NVIDIA is, right, it's like, I'm not saying that it's a bad company, and we've never actually said it's a fantastical company, probably will be worth 10 trillion long into the future. My problem is how it's getting there, right? If you look at companies that have weathered the storm of multiple crashes, and it's funny, Ray Dalio also talks about how you have all these companies that you don't know their merit because they haven't been around long enough with these evaluations to go through these credit cycles to really know if they're worth what they're actually being valued at. Whereas like Apple, Microsoft, they've been through .com, 2008. They went through the correction in 2017, the crash of 2020. Well, the flash crash, 2022. Like they're worth what they are at their evaluations because they have been tested over and over and over.
Well, I wouldn't say that they're worth their valuation, but they're not as
in comparison to NVIDIA, right? NVIDIA has literally gained 2.68 without any single bear market existence.
That's fair, because I was just about to say, remember that the discounted free cash flow says that the Nvidia at around this price is actually still fairly decent.
Yes,
right.
If you think,
remember that.
But the problem is that bubble territory, like it has every hallmark of a bubble.
Right.
But anyway, not to go on a tangent about NVIDIA. Let's talk about financial institutions and how everything is fine, right? Everything's fine. Nothing to see here. We're not having problems in the commercial real estate market, but yeah. Moody's puts 6 regional banks on downgrade review, which is essentially, unless you buck up to the bar and prove us differently, we're going to downgrade you next week. And those banks include that. Let's see, Old National Bank Corp, PPAC, Gladstone, and Fulton Finance has been placed under review. So these are some of the banks, and they cite actually that the downgrade is mainly due to their exposure to commercial real estate, right? So Bancorp and their exposure to commercial real estate sector. They also talk about how these banks, as the Fed started tightening, did not do anything to limit their exposure to commercial real estate, which I'm like, so you saw the bullet coming and you did nothing, right?
Right.
So they're also citing this as you saw the Fed tightening and did nothing to counteract the amount of leveraging you had. They actually cited in there why they're putting them on watch. And I'm like, wow, Moody's kind of hitting the nail on the head here.
Can you scroll up a little bit? Go back to the title, if possible. So I just want to preface something on downgrade review. The downgrade has not happened yet, right? So just, take this with a grain of salt, because we may not actually get a downgrade to begin with, right? So this may just be like a prelude to something worse, or a prelude to nothing happening.
And so again, I don't think the markets will react to it. I'm just saying it shows that when people say everything's fine in the commercial financial real estate sector, I'm like,
well, it's not though.
No.
I showed that video on one of those live streams one day where, the commercial real estate debt would go up to, what was it, like $3 or $4 trillion? Remember, after the readjustment of the loans.
Yeah.
This year. So it's absolutely insane. And I've been seeing the FinViz map, the heat map, pretty much every single week, and the financial sector doesn't really seem to be like realizing that these things are happening.
They're kind of just got blinders on. They kind of got blinders on. They're saying S&P's going up, so put money into this, right? They're just blindly, like you had said in the beginning, beginning of the video, you basically said the blind leading the blind.
So, and that's the thing too, right? That's the thing too, because you just said that the markets will probably not look at this as anything. However, they will, depending on what the other factors, how they come in. specifically the main factor that's happening this week, two of the main factors, honestly,
Oh, yeah.
and that is none other than, of course, CPI and the FOMC happening on the exact same day.
Oh yeah, you gotta love when that happens, and
Yeah,
I do want you to guess what the
I
CPI
know what it
expectations are.
I know what it is. I
Ah,
looked at it
you
already.
suck.
Yeah,
Anyway,
I know what it is.
but for the
I looked at it
audience,
already.
core expected to drop zero point 0.1 from 3.6 to 3.5, staying the same month over month, which is a little concerning. We also have CPI year over year, the CPI staying flat, and then month over month decreasing to 0.1. I'm like, so what are you pulling out this month is going to be the question.
I honestly think that it will go down.
You
Honestly,
for
yes.
core or for regular?
For all of the above, because we saw gas prices somewhat fall in the month of May. Now, in relationship to last May, I don't know, right? I don't remember, but I did I did I did think that the prices of oil did come down a little bit, smidge, enough for maybe that point 0.1 of a decrease in the core. Or I guess that's oil; it doesn't really count core. But we may get steady, right? We may get either 3.3 on the non-core or maybe just 3.4 still, which would be in line with what I said originally.
I think they're going to tick up. I think you're going to get 3.6 and 3.5. I think you're going to tick. I think you're going to stay flat on core and tick up on regular.
I don't foresee that.
Yeah,
I think
we'll
you're
see.
gonna
We'll find out
stay-
Wednesday. We'll find out who's
I
right
think
on
you're-
Wednesday.
Yeah, I think you're gonna stay the same. I think you're gonna stay the same at best case scenario. On the worst case, on the worst case scenario, you're gonna stay the same. On the best case scenario, you're gonna go slightly down. Which honestly, at this point, a point 0.1. All of these numbers can come in line, right? Or
You could even get the
or-
best case scenario that you described. It still doesn't give the Fed what they want. The Fed
Right,
looks at this and it's
exactly.
like, what? Have you all lost your dang minds thinking we're going to cut rates?
Right, right. And that's the thing too. We all know that the Fed is getting these numbers early, right? They always get like a day or 2 days
Yep.
earlier. So all the people that are saying, yeah, but the Fed's these numbers aren't going to come into account when we get the decision on Wednesday. Yes, it is, because they already saw the numbers.
Yeah, they're going to go into
Yeah.
the Tuesday meeting, and the first thing they're going to be is like, okay, the CPI report is going to be released at blah 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 blah.
Right. But it's like they already know what the numbers are, right?
Yeah.
By Monday afternoon, they already know what the CPI and what the inflation and the core CPI for the month of May already is,
Yep.
right? So all these people are saying, yeah, but it's not going to take into account. Like, yes, it will, because they get it in advance. You think these people get it like us plebeians do? No, they all know what's going to happen.
Us
So,
plebeians are last. The traders on the floor get it before us because they pay for like these news subscriptions that are like lightning fast. So the Fed knows first. Stock market traders on the stock floor get it second, and then we plebeians get it third. So we're always late to the punch.
right. So,
But
I don't know.
want to-
I kind of saw this, and I was just like, I just don't know, because even in the worst case scenario, staying at 3.4, 3.6, 0.3, and 0.3, the markets could still rally because it's.
Or do you think that if they get a number that is, let's say you get in line, right? Let's say none of the bad scenarios happen. You get in line
With
or
expectation.
or
In line
but
with
here,
expectation.
in line with expectations, or your Goldilocks scenario where you see a decrease. Will it be a momentary jump then fade the gap afterwards because you're heading into Powell basically not wanting to put risk on? Or do you think that you get the rally scenario then cause Powell to drop them, right? Because I don't think the Fed seeing it, unless you would have to get 3%, right? You would have to get really 3% in order for the Fed to have any remote confidence to say anything. And I think when in line or anything, I think the message is already set in stone for what Jerome Powell is going to say. We're going to be data dependent. We got a couple more data points before July, and one more data point. We're going to see the PPI print, the PCE again. Again, the PCE last print wasn't necessarily good for them either. So if we see continuation of this and talking about like, he's going to skirt around the question of like, how confident are you? Well, our confidence is still high, but not as high as it was, or it's not the data is not necessarily giving us reassurance. Like, he'll find a way to dance around it. But I do want to look at PPI as a secondary level indicator of what CPI could come in at, right? So For core, they're seeing the same decrease, right? And the month-over-month slight decrease on PPI, but the year-over-year is staying the same. So this similar narrative between PPI and CPI going on here. So do you think that we just get in line based on this?
I don't know. But going back to what you said before, yeah, they could do like a flash up or down on the day that CPI does come out, and then drop it as the day progresses, just to hold it steady up until 2:30, and then at 2:30 they'll swing it whatever direction depending on what Powell says.
Yeah,
because
Powell
honestly,
misses
I don't
a
think
period.
that PPI will do anything.
Yeah, Powell misses a period, market falls 10%.
I don't think that PPI will cause anything. Honestly,
PPI is going to be a flat. It's going to be the aftermath, right? So if we get a sour reaction on the day before, I think PPI reinforces whatever move we have, right? I don't think it's going to be a contrarian event where we're going to see one thing or another.
So yeah, that's pretty much all the news for this upcoming week, if I'm not mistaken.
But
right?
I do want to talk about one last thing, which is going to be, how do these numbers make any sense anymore?
Okay.
So,
in regards to the
unemployment ticks up.
Yep.
But payrolls go up even more.
Yep.
Explain to me how this makes, and here's the other concerning part. If you look at average hourly earnings, not only did you get a revision from 3.9 to 4 previously, now you have a 4.1 revision higher year over year. So people are earning more money and jobs. That's bad. This just puts a cold sweat on Powell's face, being like, "Oh, please, no, not job price spiral again." Because this is what the demand for workers is there, right? Payrolls are increasing. There's still hot demand for workers. The labor market's still hot. And again, could the Fed pivot to basically saying that we're not going to cut rates yet because there's still a strong economy and a still strong labor market that are fueling inflationary pressures that we have to wait and see for one of these things to cool?
It's funny because you have two opposing forces
that make no sense.
On one hand, well, two opposing forces in going the opposite direction. You have the inflation seeming that it's starting to come down, but at the same time you have jobs and earnings that seemingly are showing the opposite thing, that it's going up. So it's like, which do you prioritize, right? Which do you prioritize? Because remember, all of these are lagging indicators. What we're looking at right now is what already happened. So if we're looking at a 4.1% increase in hourly earnings, unemployment going up to 4.0, and private non-farm payrolls going up to 229,000, non-farm payroll, going to 272,000. You're like, okay, these numbers are screaming, according to Powell, that we still need to get more people unemployed. Those earnings need to fall because, Keynesian economics tells us that the more money you make, that's higher inflation, right? That's the higher inflation.
We need you unemployed.
They could print all the money that they want. That doesn't cause inflation. But what we do, it's what causes inflation, right? That's
you gotta love them.
Keynesian economic strategy is we're doing everything right, you're not, therefore we have to punish you even though it's our fault. So you have that, but at the same time you also have inflation it's showing instances of prospects of either coming down, it's plateauing, coming down, but still coming down nonetheless to that 2% mark. So which do you follow? Which do you prioritize more? I don't know.
Whichever one gives you the narrative of the soft landing. That's what they're going to give you, right? So if it's jobs that are showing good, focus jobs. If CPI is showing good, focus CPI. If neither, confuse the living daylights out of them.
If it's only the month over month coming down but everything else staying the same, then go with that. That's what we saw with the PCE. Everything's staying the same, all except for one PCE month over month number coming slightly down, and run it. Why? I don't know. That's just that. But I think, guys, this is where we're going to end it right here. This week's going to be absolutely insane. Catastrophe, disastrophe, I don't know what you want to call it, but it's going to be a lot of volatility. It's going to be a lot of volatility, especially going into Wednesday, of all things. So we're going to be live streaming, Tuesday and Wednesday, if I'm assuming?
Yep.
Okay. We're going to be live streaming Tuesday and Wednesday, 7 p.m. Eastern Standard Time here at Fatal Investing for YouTube and, of course, Rumble.
On Tuesday, also, guys, after our stream on Tuesday, I will be going on another Rumble Creators' stream where we're going to talk about mostly gaming, but they also wanna bring me along to just talk about like the economy and that kind of stuff, because it does affect gaming as well, right? People buying consoles and all that stuff, buying PCs. Depending on how the economy goes, that also affects us. So I will be going on their stream. It'll start around 9:30 p.m. So after our stream, and it's just gonna be me, and we're gonna be talking about that kind of stuff. So it'll be fun. And yeah, guys, thank you so much for watching. Really does help her with the algorithm on YouTube as well as Rumble. Make sure to follow us on XFL Investing. And if you would like to join our Discord, the static link should be in the description below. So with that said, guys, peace out, and we will see you all next time.